Okay, great. Thank you for all of that. Okay, there's going to be still some people joining us, so we're just going to let them come on in when they're all good and ready. Thank you guys for all being on time. We are going to get underway. Can you guys see my screen?
Yes.
Excellent. Okay. Okay, wonderful. Great. Well, thanks for being here. I know it's a Friday afternoon. I know there's 100 things you are thinking about doing right now, and one of them is not sitting on a webinar with me. So, thank you for being here. This is not a pitch. I'm not going to be trying to sell you something at the end. There is no upsell. What this is, honestly, is an analysis of the most significant investment thesis I've seen for our profession and a practical conversation about what to do about it. So, for those of you that don't know me, my name is Peter McCarroll. I run a CAS practice. I'm based in Toronto, originally from New Zealand, which is why you think I have an accent, but it's you guys that have the accent, not me. I've been in public accounting for about 30 years now. I serve small and mid-sized businesses across Canada, New Zealand, and also in the US. We do bookkeeping, financial statements, tax, advisory, the whole gambit. And like many of you, I'm a profit first professional. So when I tell you what I'm about to tell you, please understand that I'm talking about my own practice. In fact, that's how I got into this, thinking about this. I'm not an outsider or an academic or a vendor with a product to sell. I'm in the same room as you, and I am trying to work out what the heck is going on here too. 2 weeks ago, Sequoia Capital published something that changed how I'm thinking about the next few years of our profession. For those that don't follow venture capital, and I would be in that category, Sequoia is arguably the most successful venture firm in history. They have backed the big successful names like Apple, Google, Stripe, Airbnb, and more. So when Sequoia publishes a thesis about where the next trillion-dollar company will be built, founders listen and investors listen. And the markets that they name as their targets should listen too. Now, I assume that most of you are here because you've read the article or watched the video. You signed up because you wanted to talk about what comes next. So let me move quickly through the thesis. That's the train that's coming. And then we're going to spend the second half of the session on how to respond. That's the part that really matters. And just for the record, yes, this is being recorded. Yes, I will send you out the notes. No, you do not need to ask me for the notes. And if you are here and someone gave you the link and you haven't signed up for the webinar, you can go to the website right now, theaiaccountant.ai, and there'll be a little pop-up box that shows you there, and you can just sign up for the webinar, and that's how you'll make sure you get the notes from this webinar and all my weekly newsletters. Okay, so let's jump into it. So the Sequoia thesis. It's called Services, the New Software. And the core argument they make is that for every dollar spent on software, $6 are spent on outsourced services. So if you sell the tool, you're in a race against the model. Every time Claude or GPT gets better, your product gets commoditized. But if you sell the work, every improvement in the model makes your services faster and cheaper. The model getting better doesn't kill your business, it makes your margins wider. And then they wrote this, and this was in the first paragraph of their article. They say that a company pays $10,000 a year for QuickBooks, and they pay $120,000 a year for the accountant to close the books. The next legendary company will just close the books. They are not talking about a new software product. They aren't talking about replacing the software. They are talking about replacing the person who uses the software. They're talking about you and they're talking about me. Now, here are the numbers. 50 to 80 billion dollars in outsourced US accounting and audit. 340,000 accountants, have been lost in the last 5 years. 75% of the CPAs in the US right now are nearing retirement. Sequoia looks at these numbers and they see the most attractive disruption target in professional services. They draw a sharp distinction between two types of AI companies. A co-pilot sells the tool. It makes you more productive, but an autopilot sells the work. It sells directly to your client. The co-pilot captures the tool budget. That's the $10,000 part of the equation. The autopilot captures the work budget. That's the $120,000 part of the equation. That's where the venture capital is going. Now, Sequoia's opportunity map plots industries on two axes: outsourced to insourced, intelligence to judgment. The upper right quadrant, outsourced and intelligence heavy, is autopilot territory, and that's where accounting and auditing sits. 50 to $80 billion every year. Tax advisory is also there. Notice that it's 30 to $35 billion. So combined, this is an 80 to $115 billion market. Now let's look at the top left quadrant. They've got management consulting there, another $300 billion category. And it's in the co-pilot territory. Why? Because it's judgment heavy. It's outsourced, yes, but the work requires contextual reasoning, relationship management, strategic thinking. The kind of work that makes AI a tool, but maybe not yet a replacement. Now, this distinction matters because it tells you exactly where to position your practice. The work in the top right gets automated. The work in the top left gets augmented. And advisory, that's the advisory work that sits inside your CAS practice, lives in that top left quadrant. And that's the bridge that we're going to talk about in the second half of this session. Okay, we're going to jump into a really quick poll. So Mahan, if you could load up that poll. So we just want to check where people are at in the room. What percentage of your firm's revenue comes from compliance and bookkeeping work? So non-advisory work. If you could all just jump in there and pick an option. We're almost there. Got a couple of you still to respond. We'll give you another few seconds to do that. Okay. So where are we right now? So the really good news is that about 40% of you are over 75%, and another 20% of you are already in the 50. Sorry, that's not the good news. It's the bad news. 40% are in the 75% or more of compliance work, and another 20% are in the 50 to 75. So this means that more than half of us, the majority of our practice is compliance work. And that tracks with what we see around the industry. And so what this means in Sequoia's framework is that the majority of your revenue sits in the quadrant that they're telling founders to target first. Not because it's easy, but because it's pattern based. And this is not a comfortable number, but it's the number that tells them where to focus their investments and tells us where to focus the rest of our conversation. Okay, we can close. I'll just show you the results there. I thought I'd already done that. Okay, so Sequoia gave three conditions. They didn't just say services are the opportunity. They're a lot more specific than that. They identified three conditions that make a service market ripe for autopilot disruption. Three tests. And I want to walk you through these because this is where it gets really personal. Condition one, the work has already been done, outsource the building. outside the building. It's already outsourced. The company has already accepted that this function lives with a third party. There's no cultural resistance to overcome here. The outsourcing decision has already been made. Condition two, there's an existing budget line. The company is already paying for this. And autopilot doesn't need to create new demand. They're not trying to convince you that you need something new. They're just going to convince you to switch vendors. It just needs to offer a better price or a performance ratio than their existing spend. And condition three, the buyer is purchasing an outcome, not a process. They don't care how the books get closed. They just care that the books get closed. Replacing the service provider isn't a restructuring. Sequoia's exact words, it's a vendor swap. And here's the personal bit. Your clients already meet all three. Your clients have already accepted that the work can be done externally. That's why you have a job. There's an existing budget line. It's called your invoice. And they're mostly buying outcomes. And I know some of you will push back on me on this one, and we'll talk about that in the second half. But they're already buying largely an outcome. They want accurate financials and filed returns. Replacing you isn't restructuring, it's just the swap. And the first thing a lot of people say is, well, what about the staffing crisis? The profession has been reading this as job security. Hey man, there's less accountants out there. They're all retiring, so I've got a guaranteed job, right? Well, Sequoia reads it as your replacement's opening. The autopilot doesn't need to be better than a good accountant. It needs to be available when a good accountant isn't. And right now, good accountants aren't available. How many of us are already turning down work, maybe for smaller clients, maybe for clients that aren't in our niche? And where are they going to go? Well, a lot of them are going to end up first going to these kinds of services. Now, companies like Rillet, Basis, even TaxGPT, Scalar, these are already funded. They are building now. They are backed by the same VCs who published this thesis. Sequoia is not predicting the future. They are funding it already. Okay, so let's go to our second poll. This is about what you're seeing on the ground. So what I'd like to know is, have any of your clients already asked about AI bookkeeping or automated accounting services in the past 12 months? Okay, so maybe you've had, several inquiries. Some of you are just one or two. Others are saying, no, I haven't heard this yet, but I know it's coming. So I'll give you a few seconds to respond to that. Okay, last call. Thank you. Okay, so most of us are in the one or two or no, they expect that we will. 47% have said they have already had these numbers. That's actually higher than I expected. What this tells us is that we are already hearing about it, and we expect this to get more vocal, not less vocal. Okay, let's talk about intelligence versus judgment. And this is the distinction that determines whether your work gets automated or augmented. And I need you to be ruthlessly honest with yourself about which side of the line your daily work actually falls on. Sequoia draws the line between intelligence and judgment. Intelligence is internalized rules, pattern matching, learned decision trees. Look at your practice honestly. Transaction categorization, bank reconciliation, work paper assembly, compliance filing, the monthly close, routine reporting, even tax preparation. These all follow rules. Yeah, they're complex rules. The public don't know how to follow these rules. Absolutely. But they are all rules. And you have learned them over many years and you are an expert in them, but they are still just rules. The genuine judgment layer is real. The advisory conversation where you tell an owner that their margins are eroding and here's why. The complex tax strategy that requires understanding a client's family, their business structure, and their risk tolerance. Cash flow planning, where the numbers say one thing but your gut says another. The call at 10 p.m. Your knowledge of the client's business and their marriage and their ambitions. That layer is defensible. No startup can replace it. But here's the honest part. Most of the tasks in the average CAS practice cluster on the intelligence side. If you pulled that work out, the remaining advisory revenue wouldn't sustain the current business cost structure, not the current team size, not the current overhead, maybe not even the current owner's draw. What we call professional judgment, which is the biggest excuse I hear people saying for why this won't affect us, is for most of the working week intelligence work. The genuine judgment residual is maybe 10 to 15% if a practitioner's week. That's the defensible moat. Everything else is in the crosshairs. And as I said earlier, tax work isn't exempt either. Sequoia says that 80 to 90% of the underlying tax work is just intelligence work. The complexity that you bill for, multi-state, multi-jurisdictional, is exactly the kind of pattern-based complexity that AI is built to handle. And here's step two of this argument. And this is the part that keeps me up at night. The line between intelligence and judgment isn't fixed. Sequoia's most important line in the whole thesis is this: today's judgment will become tomorrow's intelligence. As AI systems accumulate data about what good judgment looks like, the frontier shifts. What required experienced professional judgment in 2026 becomes learnable pattern recognition in 2028. What seems like it requires human intuition in 2028 becomes a training data set in 2030. The frontier is moving rightward. The judgment zone is shrinking, and the things you think are safe today won't all be safe in 3 years from now. I actually wrote about this earlier this week. The convergence is accelerating faster than most practitioners realize. The safe zone isn't stable, it's contracting. The question is whether you're building your practice on the side that's growing or the side that's shrinking. Okay, we're going to jump to the next poll. And what we want to know here is, what's your biggest concern about AI disruption in your practice? Now, there is no all of the above button, so please pick the one that you think is most concerning to you in your practice. So Mahan, if you could put that up, thank you. No, yeah, Mahan, if you could put that up, please.
I've
Okay,
put that up. Can
it
you all
is.
see it? Yeah.
Okay, yep, that's starting to respond now. I wasn't seeing any responses. I wasn't sure it was up. Okay, so if you all just take a second and pick one of those. And I'm going to go and let my cat out of the room because it's making noises. He was looking at me like, what do you mean I'm making noises? Okay, great. A few more responses, please. Got almost everybody. Okay, last chance. Thank you. Okay, we'll end that there. Okay, so about 50% of us think they're worried about clients leaving for automated alternatives, which is pretty much the same as losing compliance revenue. So when we combine those two items together, we're at 75% of our concerns. And that's the right concern. It's the most addressable one as well. The answer isn't give up compliance revenue. The answer is deliver compliance via AI yourself and keep the client so you can focus on doing advisory work. Okay, so let's talk about the pivot point. What are we going to do about this? So the first half of this has been all about the Sequoia, um, I called it a manifesto. And so the second half, we want to talk about what to do. Now, before I move on, we're a little ahead of schedule. So I'll just open it up for questions. Um, if you have the ability to unmute yourself, you may go ahead and ask questions about the Sequoia, yeah, the position that we've documented so far. I'm not going to talk about responses because that's going to come up in a second. So does anyone have a question? Kevin, you unmuted yourself. Feel free to jump in.
Just the thought of Sequoia, if they jump into this environment and reduce price, how far can they go down before it's not profitable for them?
That's a really good question. And what we've seen already with firms like Bench is they go down too far. But I'll tell you that the technology shifted in December of last year so that a startup today will be able to do what Bench failed with at least 50% more likelihood of success. Would you agree with that, Mark? He's nodding.
I would say that that's conservative.
Yeah.
Uh, it's the economics are just changing so rapidly, literally by the day.
Anyone else want to ask a question or reflect on what we've covered so far? Otherwise, we'll move on.
Well, the last poll that poll number three, I was thinking staffing was my issue.
Hmm.
And because the question I was realizing is I can't hire somebody unless they're using AI pretty like fluently. If they can start to step in and prompt and build things quicker, then they can really help me. But if they don't
Yeah,
have that, they're done.
absolutely. Yeah. And so there's a paradox there. You can't find people to do the work the old way, and the new way requires a different set of skills. So
Yeah.
the staffing crisis is now, both the threat and the reason to change. Yeah. It requires a new way of training, a new way of hiring. I wrote about this a couple of weeks ago. One of the challenge with the train, I called it the training gap, is that um, we're struggling to find staff, and AI is going to be a savior for that. It's going to help us. It's like, wow, AI is going to start doing the work. I don't need as many staff. But this also creates a new problem. Well, in 5 years' time, where are your seniors and your managers going to come from? If they never learned how to do the work, and how do we learn the work? Well, most of us are a little older in the tooth. How do we learn to do the work that we do? We did bank rec after bank rec after boring bank rec, and we learned what it means when a client's financials don't feel right. And we learned how to dig through all that because we did the work. Well, our next generation won't have done the work. So how do we now have to think about training totally different than we used to, because we still will need people who will know how to sniff out a problem in financial statements. That's part of the advisory journey, isn't it? You go to your client and you say, I'm not sure what's happening here, but something smells off. And that's a new challenge. So it creates a totally different training model, totally different hiring model. We've got to start really thinking differently about what our practices need in a few years from now, and then also in 10 years from now. Okay. Thanks for your comment there, Ty. Okay, well, let's go on to the next half, the more interesting half. Okay, so I want to propose to you the pivot that we need to make. And there are four moves that we need to be thinking about. Okay, so we're going to just go through these one by one. So the first move is that we actually have to embrace the thing that threatens us. If we just get scared and run away, well, we're going to die. It's guaranteed. Our business will shut down. And the image I had in my head when I started thinking about this, I actually remember it very clearly. It was early 2024. I just finished busy season, and I was listening to people like Mark Kudray and the accountants podcast and a whole bunch of other places talking about what was happening with AI. And I had not touched anything in AI. And I remember thinking and hearing all this stuff and thinking, oh my goodness, I don't think I've got more than 3 years left in this business. And I didn't want to be the guy sitting on the side of the road crying because a tank had just run over my business. I wanted to be the guy sitting on top of the tank with a lasso. That's what started my journey to really thinking about how this impacts our profession and what do we need to do about it. Because I think, and you might call me a pessimist, I think it's inevitable. And the analogy that I'm using now is that the train has left the station. The Sequoia Manifesto was the final all aboard from the conductor, and it's now picking up speed and it will not slow down. Hasn't reached the next station yet, but it's on its way. It's coming and it's now inevitable. So we have to ask, are we going to accept this as a reality and learn how to work with it, or are we going to get it run over by it? So pivot number one is deliver compliance via AI. Now, this is hard to do right now. Our tools do not do this very well at all. And every time they try, I think they make it worse. And learning how to use AI in your practice around these primary tools that we are using is still a struggle. And I wrote about this last week about what I called AI in the gaps. You can find that all on my blog site. So what we have to do is we have to look for opportunities to rebuild our firm with this new reality coming in. Okay, so the most important strategic decision you'll make in the next 2 years is this one. The instinct when you hear that it's getting automated is to retreat to advisory only and to let the compliance work go. And I think that's the wrong move. The right move is to become the one who delivers compliance via AI. You adopt the tools, you run the automation, you keep the client relationship. That is the key part. If a bookkeeping autopilot can close the books at 20% of what a human bookkeeper costs, there are two outcomes. Either the startup captures the client and keeps the margin, or you capture the efficiency and keep the client. The client doesn't really care which one happens. You should care a great deal. The practitioners who adopt AI the fastest don't lose the compliance revenue. They keep it, might be smaller, and they deliver it at a lower cost. And that's not a retreat. It's actually an upgrade. It secures the future of your business. Now, what does this look like in practice? As I said, this is still early days. So it's really hard to know exactly what this will look like a year or two from now. Most of you open your laptop, you face an undifferentiated review queue. Every file looks the same. You review everything, not because everything needs your judgment, but because nothing in the system tells you which files are clean and which ones have problems. You're a manual sorting machine, scanning 15 files to find the two that actually need your attention. As we rebuild our firms, we need a different model. We need quality systems that process the work before it reaches your desk. Each file gets a confidence signal, clean data, reconciliations balanced, nothing unusual, or a flag. Hey, there's something here that we're not sure about. High confidence work gets a glance, but flagged work gets your real attention. First hour of your day should be rapid triage. Genuine judgment calls on genuine exceptions. After that, the bottleneck clears. Your staff have direction, and you have something most practice owners never have: uninterrupted time for advisory, for client relationships, and the work that actually generates these premium fees. Same compliance revenue, maybe lower, but fundamentally different cost to deliver. Here's where you start tomorrow. You pick up your messiest recurring client, the one where the bank feed's always a disaster, and you start experimenting with AI. Can AI help me categorize their bank feed? Can AI help me clean their bank feed so I can import it? Don't replace anything yet. Just start comparing. That's your proof of concept. Okay, you'll have some data within a week. The data is what's going to move you from thinking about AI to actually using AI. Okay, segment number two, or move number two, price for outcomes, not hours. Now, let me be honest with you about something here. Your fees are already under pressure. You might not be feeling it yet in your practice, although some of you have said you've already got the questions, but the market is shifting. KPMG is offering AI-powered bookkeeping to small and medium businesses. Pilot raised $250 million to automate startup accounting. These aren't garage startups. They are well-funded operations targeting your client base with dramatically lower cost structures. One of the first articles I published in February was an article about KPMG. I think it was KPMG demanding a discount on their audit fees. This is KPMG International, demanding that their auditors reduce their audit fee, not because they were using AI and making too much money, was because it should now be possible to do it cheaper. And they won. They got a 14% discount. So if our own can do it to our colleagues, your clients can do it to you. So if your pricing model is built on hours, you have a problem that's about to get very, very worse. Every hour of intelligence work that AI can do in minutes compresses your billable base. If you're charging by the hour for bank reconciliation and an AI can do it in 3 minutes, you've just reduced the amount you can bill significantly. The answer is value-based pricing. We've been hearing this for years. Advisory retainers, fixed fees for outcomes. We manage your financial operations for X dollars per month, not we bill you for the hours it takes. And when AI makes delivery faster, your margin can go up instead of your revenue going down. But here's the deeper point. The antidote to fee pressure isn't cheaper compliance, because they will put pressure on your fees because it can be done cheaper. It's demonstrating business value that justifies the fee. A client who pays you $1,500 a month to close the books will leave for an autopilot at $300 a month. A client who pays you $1,500 a month because you caught a cash flow problem before it became a crisis, because you modeled 3 pricing scenarios that increased their margins by 6 points, or because you called them before they knew there was a problem, that client isn't leaving. The fee is justified by the outcome, not the activity. So the best CAS practices have already been moving towards value pricing for years. And those of you that are in our Profit First community, this is old news for you guys. What changed is that it's no longer optional. If you're still billing hourly for compliance work, you're pricing yourself into a compression that accelerates every quarter. Okay, move number 3. Build the judgment layer now. If advisory is the defensible ground, and it is, at least for the foreseeable future, then you need to be standing on it before the flood hits. Now, I know what some of you are thinking. That sounds great, but I'm a bookkeeper. I'm not giving advisory. What does advisory even look like? Well, that's the right question. It's more accessible than you actually think. Let me walk through 4 areas that you could be thinking about, starting with the easiest on-ramp and building from there. So the first area is financial reporting and insights. This is where you start. And if you're a bookkeeper that's never done advisory, this is the smallest possible step. You're already producing financials. You're already closing the books. The advisory layer is adding a 1-page summary that says, here's what the numbers mean. A quarterly financial performance review, reviewing the last 12 months, identifying the trends, flagging what's changed, knowing key metrics and KPI dashboards, customized to the client's goals. Make it visual, make it tangible, make it unique to them. Performance indicators, quarterly review and interpretation of recent business performance. Flagging trends before they become problems. You already have the data. You already know the data. The advisory work is telling them what it means. And this is not a stretch. That's a conversation you're probably already having informally. You've just not been packaging it, pricing it, or delivering it consistently. Second advisory area. Again, Profit First professionals know this very well. Cash flow and forecasting. Cash flow forecasting and management. This is where advisory gets proactive. Maybe you build 3 scenarios: best case, base case, best case, worst case. Show the client where they're tight, where they're comfortable, where the trouble might surface, and then monitor against it with actual results. When revenue comes in 15% below forecast, you reach out immediately before the client has to call you. The cost of monitoring is almost zero because AI does the watching. The value is enormous because you're catching problems early. You add to this budgeting and financial planning, annual budget prep, budget versus actual tracking, quarterly reviews. You already have the data. The budget conversation is the advisory layer on top. These are the conversations that make clients say, I can't imagine running my business without my accountant or my bookkeeper. That's the relationship that no autopilot can replicate. The third area, profitability and pricing. Profit improvement. This is where you start changing the numbers, not just reporting them. Profit first implementation, margin management, allocation discipline, owner's pay structure. This isn't abstract consulting. It's sitting with an owner and restructuring how money moves through their business. You already understand the numbers better than anyone. A lot of this is psychology work. I tell all my profit first clients that I'm messing with your brain. It's got nothing to do with your actual numbers. It's about how you think about your business. It could be pricing reviews. Are they actually charging enough? Well, most people aren't. You have their financials. You can model what happens if they raise prices 5%, 10%. You can show them the impact on margins, on cash flow, on owner compensation. That's a conversation worth paying for. Maybe it's expense analysis, revenue growth opportunities, cost reduction strategies, price optimization. These are defined services with defined deliverables, not vague advisory conversations. They are products in their own right, and you can price them accordingly.
Peter, can you go back a slide? It has to be number 23. Thank you.
Did I click an extra one? Did I?
Yes, I sent you a message earlier, but I
Oh,
guess
I
you
can't see the
wasn't sure.
message. Sorry.
It's okay.
Okay, area number 4 is strategic and emerging issues. This is partner level work, and it's the highest where the highest premiums live. Client decision briefs. A business owner faces a decision: do I hire or do I outsource? Do I invest in equipment or do I lease it? Do I expand or deepen? And so you sit down initially with AI yourself, and that helps you pull out the client's financial data, their cash position, their growth trajectory. It produces a branded decision brief with 3 options, including do nothing, and the key trade-offs that your recommended opinion or option with your reasoning now helps the client make a valuable decision. The whole process takes about 90 minutes. Without AI, that could be hours of time. With AI, you are now accelerated in being able to give the client useful advice. It could be the entity restructuring conversation, when the current structure is costing the money. S-corp election analysis, multi-entity consolidation, asset protection. You're already doing the tax work, many of you. This is the advisory conversation that sits on top of it. It could be capital and funding advice. Capital needs assessment, funding options need to be reviewed. Connections to funding sources need to be found. When a client needs to finance growth, you're the one who understands their numbers well enough to help them make the case. And here's one that's emerging fast, and I really haven't focused enough on this yet. AI governance advisory. 79% of businesses are already using AI in some form, but only 14% trust how it's being used in their organizations. Your clients are in that gap right now. So there's opportunities here for risk assessment, compliance frameworks, cost benefit analysis. That skill set maps directly onto what you already do. You just need to translate it. And here's, I think, probably the biggest shift for me. We call it the advisory shift. There's a thread that's run through all 4 of these areas. Most advisory today is reactive. You've got a scheduled monthly meeting with the client. You're reviewing their financials, or the client calls you with a question. They have to make a decision and you give them an answer or your opinion. But you wait for the next call. Proactive advisory flips that model. You're monitoring the client's data continuously. You're not waiting for the monthly close. A trend breaks, a metric moves, an opportunity surfaces. So rather than waiting for the next scheduled call or waiting for your client to ring and ask for your advice, you reach out proactively. You flag it. You start that conversation earlier. The firm that calls the firm that calls their client before that they know there's a problem is the firm you won't leave. That's not just a service upgrade. That's a completely different competitive position. And it's a completely different price point too, by the way. Every CAS practitioner I know has clients who would benefit from more advisory. Most of these practitioners never make the offer because they're too busy doing their compliance work. The irony is that the work keeping you from advisory is the same work that's about to get automated. So take advantage of it. Use the automation to free yourself for the work that actually matters. Okay, move number 4. Reduce your exposure timeline. Now, the question is not if this happens, I don't think. The question is only when will this happen? And unfortunately, the answer is it's sooner than you think. But it's not overnight. We have a window. We are able to prepare. The models are good right now, but they're not perfect. The startups are funded, but they're not yet up to scale. The market is warming to this idea, but it's not yet hot. That window is your restructuring period. You should use it. If you wait until the first client leaves for an autopilot, you're already behind. If you move now, adopt the tools, shift the pricing, build the advisory layer, you're the practitioner who absorbed the disruption instead of being replaced by it. Think back to my tank vision I had a couple of years ago. You want to be the guy on the top with the lasso going yeehaw, not the guy on the ground crying because his business just got run over. The firms that survive this won't be the ones who ignored it. They won't be the ones who panicked. They'll be the ones who moved deliberately and early with a clear understanding of what is defensible and what wasn't defensible. So here are 3 things that you should be thinking about this week. Not this quarter. I know it's busy season and you're all going to tell me, I didn't have time for this webinar. You want to give me homework? You idiot. No, I'm not an idiot. This is this urgent. So number 1, audit your revenue split. Take your last 12 months of revenue and categorize every engagement, every service line as intelligence work or judgment work. And be honest. The number you get is your exposure number. That's the percentage of your revenue that's in the automation crosshairs. 2, identify your 3 most exposed services. Which 3 things you deliver are most pattern-based, most commoditized, most likely to be the first things that an autopilot will replace. These are your starting points for AI adoption. Not because you're going to cut them, but because you're going to offer to deliver them faster and cheaper than a startup can. Because you already have the client relationship. And 3, start one advisory conversation that you've been putting off. You have a client right now who needs cash flow planning, or a pricing review, or a restructuring analysis, or a real strategic conversation about their business. You haven't made the offer because you're buried in compliance work. Well, just make the offer this week. I know, April 15th is coming, but start now. That's the work that no autopilot can touch. And it's the work that will sustain your practice through what's coming. Sequoia Capital named your market, our market. They published the playbook. They are funding the competitors. None of this is within your control. What is within your control is what you do about it and what you do quickly. The good news is you have time, but you have to start now. Okay, so a couple more poll questions here. Before we go to Q&A, after hearing what we've just covered now, how are you feeling about your practice's position? Martin, if you could throw that up. Now, this poll has 3 questions in it. So as you answer each question, it's going to immediately take you to the next of 3 questions. So if you could just go ahead and choose which of those options apply in each of the 3 questions, that'd be great. I'll give you a few seconds to do that.
I think this one is all of the above.
Yes. Yeah, the all of the above will be those that don't answer the question. They're just paralyzed. Okay, we've got less than half of you that have responded to the last question. So see a couple more seconds there. Okay, I'm going to wrap that up. So if you go a second to get your last answer in there, 3, 2, 1, and it's gone. Okay, so the results here, not necessarily that surprising. Um, Over half of you, almost 3/4 of you are either energized or motivated, which is really good. That was my goal today. I was not trying to scare you. I'm not trying to be the sky is falling kind of guy. Yeah, there are some problems. Let's be realists, not scaremongers, and let's actually look at solutions, not problems. Question number 2, what was most valuable to you? Well, was this valuable? Yes. Okay, great. 80% of you found it very valuable or extremely valuable. So I like to hear that. I'll always appreciate feedback, by the way. So you won't offend me by telling me that something sucked. So just email me and tell me what you liked the most or what I could have improved. Okay, we'll go on to just one last thing. I've got the poll questions there. We've covered those. Great. So thank you so much for coming to join me. If you have any questions or things you'd like to just follow up on, we've got plenty of time. I'm happy to stick around past the top of the hour if people have got questions. But let's talk about what this means and how we should respond to it.
Can we just come off mute?
Yeah, just take yourself off mute and go.
Okay. I I'm wondering about the cost. I We've got a competitor in the e-commerce space, which is our niche, and they are offering cheaper bookkeeping, but now it's found out that it's really not AI. That's how they advertised that it's remote overseas workforce doing the work. Um, and just thinking about the pricing, I'm just like, how long can they keep up the pricing if AI is not really there? And I guess they've got enough venture capital to maybe weather the storm because the word is they're spending like $1 million on marketing.
Yeah.
But I'm really wondering at what point, what's going to be their price point? I mean, theoretically, it could be substantially cheaper, but how much is that value that our clients are used to paying for? How much will they actually go cheaper? I don't know. Just thinking about the pricing, I know their cost will be cheaper. Just thinking about how they'll position themselves from a pricing perspective.
Yeah, it is really hard, and unfortunately, these VC-backed guys spend more money on marketing than they do on development.
Mhm.
And that creates a massive problem because what they end up doing is they end up creating churn
Mhm.
that then costs the clients more. I mean, was it Bench, as a classic example here. They sucked a lot of energy out of the market, people looking for cheap fees, and then ended up folding. And then they're not the only one. There's been several of them that have done that. And to be honest, there's going to be more. And we're going to go through a very turbulent time as these people start offering cheap services. Now, here's the distinction that I want you to start thinking about. It doesn't matter how they deliver the service, whether they've got cheap people in the Philippines, whether they've got a slave camp in China. It's not going to matter how they deliver the service, digital or human. What matters to your customer is, are they willing to switch for a cheaper price if all they value is the compliance? Okay. The only way to defend against price challenges is to offer a service they can't afford to leave.
Makes
It's no
sense.
longer about the price they pay. It's about what they would give up to go away. That's the only thing that we can use to defend ourselves. And we can't justify premium prices on compliance with that model either. Now, we might be able to charge more than a totally automated firm, but what we have to back that up with is you can't afford to leave me, because we help you run your business. We help you make more money. We help you do something that an automated bookkeeping system won't do.
Okay.
So that's the key thing for me.
Okay. All right. Thank you.
And I don't know where the price is going, by the way. Every estimate that I hear is 10 to 20% of current pricing.
Okay.
That's very scary, isn't it?
Honestly, not as bad as I expected.
Okay. Mark, did you want to comment on that?
Oh yeah, there's so much here. Great presentation. Many of you know me from Profit First. I've been involved with AI since 2015, way before the LLMs, way before it was on anybody's radar. And I got involved with it because I was looking for patterns, and I was looking for ways to understand patterns within large data sets. And there's a few observations that I would share, because I'm up to my eyeballs in this now for a good 10 years, and the last 4 years or 5 years have been crazy. I would absolutely concur with Peter's analysis. The sky is not falling. You're in a state right now of awareness. You're aware that things are changing, and you're trying to balance them against the way you've always done things, against the anxiety of the unknown, of the future, where this is going. I work with lots and lots of $1 million to $10 million companies. And in the last 24 months, we have analyzed 310 or 300,000 customer years of data. And this is from year 1 to year 10. And we have 99% confidence, statistical confidence, in the first 5 years. So we can tell you churn, we can tell you growth, we can tell you industry segments in terms of what markets work well, which ones are have lower margin, all of those kinds of things. Because we were looking for patterns, and nobody has this information in the SMB space, the small business space. And the things that we have observed and that we're acting upon is that what your clients will pay for moving into the future is your experiential knowledge and guidance, not advice, guidance. And guidance is based on what is in the data that's defensible. You can show them what's actually going on. And so we look at AI, we use it as recognizing patterns in the data, receivables, seasonal cycles, products analysis, all those kinds of things that you normally see in a bookkeeping review month by month. But we see those patterns, AI takes those patterns, and then it creates the next step, which is the predictive model. Based on what we've seen, here is the predictive outcome with this probability of these actions if you keep doing these actions. Is that true or not true? Well, probability is there's going to be winners and there's going to be losers, and this is your chance of winning or this is your chance of losing. Your role as an advisor and as a knowledgeable financial expert is to improve the prediction probability for your client so that you can do the third element of the AI model, which AI can't do right now and won't for a while, and that is the prescriptive outcome. You're prescribing the actions to apply to the business to get a specific outcome. And I was really glad to see in your survey that you had a category there about outcomes, because our value is about outcomes. It's going to change the view from being driving in the rearview mirror, analyzing events that have already taken place, to using that data as close to real time as possible so that we could provide a future vision with a probability of outcome so they can make decisions faster. And that they're paying a lot of money for that right now.
Mm-hmm. Yeah. Yeah. Thanks, Mark. Anyone want to chime in on that? I got some questions that have come through the chat. A couple of people have asked about Puzzle, and a couple of people have commented on Kick. I had a look at, I haven't heard of Puzzle yet, actually. I looked at Kick and decided it wasn't ready. Now, keep in mind, I'm in Canada, and in Canada, we have different issues with refundable sales tax and all this sort of stuff, complex sales tax, way more complex than the US. And it wasn't ready for, and of course, we have to do accrual accounting from day one. We can't get away with your sloppy cash book accounting or cash accounting methodologies. And so basically, what they were doing, in my humble opinion, was what I call sledgehammer accounting. Coding items off the bank statement with no supporting detail whatsoever. That doesn't fly in Canada. But for many small US businesses, that works. So they are a good option for a US cash-based business with a fixed chart, and they only have a fixed chart of accounts. You can't choose your own chart of accounts yet. And they don't do receivables, don't do payables. So, they're only doing a really narrow slice, the easy slice. But they will get better. Haven't heard of Puzzle. So be keen to hear if anyone, Kathleen, if you end up trialing Puzzle, that would be great. And who was it? Joy, you said you were trying to use Kick, but you couldn't find anyone willing to switch. Here's what I suggest. Don't ask your clients. Just do it in parallel. Take a couple of clients and do it in parallel and assess the difference. You might have to get your client to sign in for a bank feed or something like that, but just tell them you're experimenting at no cost to them. You will learn an awful lot from that parallel exercise. You'll also learn what the tool is good at and what it's not good at.
There's some questions I saw in the chat about like what to do. Can you describe like in parallel, what could we do? What could we implement? Like what's an example or some examples?
Yeah. So in terms of trialing a new system like Kick or Puzzle or Digits, is sign up with them and then do the bookkeeping twice. Okay. Let the bank feed come into Puzzle, let the bank feed come into QuickBooks, and see if it's more efficient in Puzzle. I'm really interested in Digits. They are looking like they're going to be charging at least $100 per month for their service. But that might replace the bookkeeper.
What I was looking for is a non-SaaS, like not another platform. Like what about tools that like we could like a Claude or something like a Cowork?
So I've written a couple of blogs on this. I'll be doing a lot more in the coming weeks and months. Two things that I'm really interested in right now. So what I call AI in the gaps. For most of us, we're trapped inside our accounting platforms, QuickBooks, Xero, whatever platform you're using. Maybe you're using Dext or HubDoc to feed documents in there. That's really hard to eliminate. And our tools, unfortunately, are trying to build bigger walls. I actually think that this is going to be the downfall of these tools. Rather than saying we need to open up more, they're actually saying we need to close in more. Yeah, they're going to add some AI tools in there, but just look at what they've tried so far. It's been a real joke. And what we actually need is we need more agent-friendly systems, not less agent-friendly systems with their own agents trying to tell us how we should do our job. That they don't appear to be interested in that. Okay, and I think it's going to cost them both. Xero. I now put Xero in the comfortable incumbent category, not the scrappy startup category. Digits is now the scrappy startup that will eat them for lunch. I hate to say that because I'm a Xero award winner and I really like Xero, but that's how I see them now. They're doing all the things that Intuit was doing 10 years ago. Building walls, charging more, wanting you to stay inside their environment, and they tell you what you can and can't do. It's exactly the same thing. So what else can we do here? So I look at what I call AI in the gaps. What can we be doing outside of their systems that make us more efficient? This is still only incremental. This is not a rebuild, but it's preparing for the next phase. So I love Claude Cowork. I use this every day now. I'm writing a book on Claude Cowork for accounting firms. I hope to have it out by the end of the month. But I said that earlier this month, and I still haven't finished it because of this stuff. And I'm finding it incredibly valuable for my own work and the ability to be able to complete what they call skills and then be able to share them with the rest of your team. So that's definitely an area to look at. ChatGPT is doing really well. I'm not anti OpenAI at this point. In fact, their new model, I haven't really played with it myself, but 5.4 is apparently the best model for financial data right now. Okay, and people ask me what's the best system to use. If I told you an answer today, it'd probably be different tomorrow. And I think the reality we have to get used to is we are going to need to have multiple subscriptions because different tools will work for different things. Okay, I have three right now. I have the $200 a month Claude plan because I was maxing out the $100 a month plan. And I have Gemini as part of my Google Workspace suite because we're a Google shop. And I still have OpenAI's ChatGPT team plan. Although to be honest, I don't use it nearly as much as I used to. I'm mostly in Claude. But I think the reality is, at least for the foreseeable future, you'll find one tool that you really like working with. For me, that's Claude, but you'll need a second. For what Claude doesn't do well, ChatGPT will do. And maybe not everybody gets that plan, but a few people will need to have that secondary account. Okay. On the website, I have published a little guide called AI in the Gaps. If you go to the resources page, you'll find it there. And what that is 100 starting ideas for where you could use AI in the gaps between the big systems. Now, it's not workflows. I'm not giving you 100 workflows. I'm giving you 100 starting ideas. And I've given you a prompt that you can then put that idea into this prompt and it'll start helping you flesh that out. Okay, to try and give you 100 workflows would never work for everybody because there's always something unique about them. But this idea allows you to lead through that process. So I'd recommend you go and do that. So just the aiaccountant.ai/resources. And there's a few things in there that you can go and download. And if you sign up for any of the resources, you automatically join the newsletter as well, by the way. So I publish a newsletter every week. On that newsletter, we cover the three main news stories from last week. So my weekly news roundup, if you haven't seen that yet, that's a regular thing. So the newsletter will tell you the three main stories from last week's AI news that relate to accountants, and it'll also tell you what I published last week. I'm right now publishing 7 days a week. There's just so much going on that I have stories backed up, in case things slow down. And so far, I've never had to pull. I've never had needed that. So things are just happening so fast, and they affect us. And one of the things I'm trying to do with my articles is, I'm looking at the technical stuff. I'm looking at what the developers are saying and what the software engineers are saying, and I'm trying to translate that into what does this mean for us as accountants. So I'm not going to talk about a model change for its own sake. I'm always going to say, hey, what does this mean for us? Where is this heading for future of our industry? Okay, so make sure you sign up for that newsletter if you're not on there already. Anything else in the comments here? Does anyone else want to just open your mic and jump in if you need to?
Peter,
Kevin, yeah.
just thinking through the path forward. I've really been in my head in this for a while now, and I think today was one of those moments of just thinking more clearly. So I appreciate you doing this with us. Um, the thought partially is the moat you mentioned, the judgment areas that we can still do better. And there seems to be a path forward where you could use that umbrella of judgment that hangs over all of the rest of the services we provide. So there's a stickiness to our firm because of that 10 to 15% of judgment we bring to the table. So the bookkeeping, the tax work, the payroll even sticks with us because we're bringing it all together.
Yeah.
And I mean, I just had this example with payroll. I mean, 25 years ago, I did payroll manually, and I don't do that, of course, anymore. But I still had a client or a prospect that wanted to pay me extra to oversee his Gusto work. Gusto does all the compliance, does all the filings, it does everything. So it's a similar model that where bookkeeping is going to, and perhaps even tax returns ultimately. But you can still retain that work under your umbrella because you're the trusted advisor, and not just on providing the advisory of specific things, but holistically, you're the advisor over everything.
Yeah. And I think you've hit on something there. I think the future of a bookkeeper's job is going to change. They are no longer going to be the transaction master. They're going to be the agent monitor. The agent is going to say, hey, I've got 98% or better confidence in all these transactions except these three. And they're going to surface those to a human to make the final judgment call on what to do next. So rather than looking at 1,000 transactions a month, you're looking at 15 or 30. Their job is to see where the system is not working, to respond, to say, hey, we seem to have a problem with the bank feed. We need to jump in there and solve that problem. Rather than, oh man, I've got 300 credit card lines to code this week. What are these guys doing? Which is how most of us react. But, the system will handle most of that. It's a matter of saying, where will the system break? Because it will, especially in the early days. It'll break. And there has to be someone with judgment to actually intervene and fix the problem. Now, will that get better and better every year? Yeah, it absolutely will. Plus, also, if the systems are being built right, they will learn from their mistakes. And they will get better. And they will work us out of a job in some of these areas. Okay. But the reality is every business is going to need a controller of some kind to spot those issues, fix those issues, and raise the, hey, here's something that's going wrong. We need to talk about it. So yeah, absolutely. At least for a while. How long? I don't know, but at least for a while. Joy, you asked about security. I've actually got an article coming out on Sunday about security. It's an excellent question. I think most people overplay the security question, is my personal answer on that. Here's where security is a problem. When you're using free product. If you've got the ChatGPT free plan or the Claude free plan, you are the product. They are harvesting your data and looking at it, and it's building their models. You should never use the free product with any client data of any kind. But everything above that, if you're on a paid plan, and some of them actually are a little better than others, but and some of them you can opt out of building the model, even on the free plan. But once you hit the paid plans, then you no longer train the model. Most of them are off by default. And you can switch it on, but why would you want to? Okay. There is a concern that some of the models aren't fully SOC 2 compliant. Now, here's the reality. Most products aren't SOC 2 compliant. It's an aspiration, at this point. However, the only way to get that fully compliant is to go up to what they call their enterprise plans, which, to be really honest with you, is just too expensive for most small businesses. But if security is absolutely that important, then you will need to be at that, at those enterprise levels. What I suspect is likely to happen is that you won't be using these tools directly in their own environments. You'll be using them through an aggregator, your practice management system, your accounting system, and they will be much more robust about security because they can afford to. That's my hunch. Okay. But as I said, I do have an article on this coming out. I think it's on Sunday. So if you want to check out for that. What else have we got in here? Kathleen says, I'm starting with a compliance commoditization, 3 tax returns into tax GPT to review for errors. Yeah. How did that go, Kathleen? Did it actually find any errors? No? Last week, I was experimenting with Claude and I wrote a year-end file review process. It took me about 2 hours. I literally just went, we have a Google Sheets workbook and I've integrated properly Google Sheets into my Claude. And I went through page by page and just dictated to Claude, this is what I do when I review this page. Okay. I then had it run the routine on the file that I was using. It took 13 minutes and found 23 problems. Now, was it the same? Like most of those problems, I probably wouldn't have even commented on myself. They're little minor issues that the staff should have cleaned up. And I'm looking at that going, yeah, the staff should have cleaned that up. They were actually good finds. I can't be bothered having to send the file back to fix those problems, or most of them I would have fixed myself. But the goal of this routine was to have my staff run it before they send the file for review, so that they do the cleanup. They learn, oh, this is what an accurate file actually looks like, not the one I get away with, because the tool won't let them get away with sloppy work. And that's going to increase the quality of our work, and it'll mean less review time for the manager and hopefully no review time for me. Because I can see, yeah, they've done the work, it's signed off, and those were the issues that they accepted. I'm okay with that, and now I don't have to do as much work. So again, it's learning to say, how do we become, only have to touch the files that are high risk, not have to touch the files that are low risk.
Peter, that so the couple files that I sent up there were ones that I prepared. So of course it didn't find any errors.
Good.
But so I'm going to start uploading some that are prepared by employees, and we've got some pretty tight preparation procedures. And my goal is to kind of be able to back off on those a little bit if we can save the time and let AI catch some of that.
Yeah.
I think ultimately that's my goal. And for $30 a return, that's a couple of our time.
Maybe it's worth it. Jason Stats talked about a month or so ago in his video channel. And if you're not following Jason, you should. He talked about defining layers of, what kinds of files should, who can prepare this who should prepare this kind of file and who should review it. And you as a senior person should not be reviewing every file. You should be able to say, yeah, these kinds of files get prepared by level 3, reviewed by level 2. I'm level 1, I don't touch it. And then maybe you say, okay, maybe that level 2 review is the tax GPT review. And if it comes back clean and it fits this definition, I'm not touching it. There's no reason for me to touch it.
That's my goal.
Takes work off your desk, absolutely. Yeah. But a large part of that is in that definition of what classification of work am I comfortable having an AI give the sign off on, because that's effectively what you're doing. You're delegating a sign off. Okay, so it's the work of sufficient simplicity that if an error got through, it wouldn't be the end of the world, and and we're expecting low problems. So therefore, when this AI says this file passes, you have reasonably good confidence that you can just let it go. And you focus on the more complicated work for which you get paid a lot more.
Mm-hmm.
Yeah. Okay, any other questions? Great conversation.
Sorry. I have a
Go ahead.
question for Kathleen. I was just curious what product you used for that review.
Text GPT.
Okay. I've got that
There.
too. I met with a prospect the other day that had 3 years worth of bookkeeping that needed to be done. He has not filed a single tax return, did not know he needed to file sales tax returns monthly. I mean, it's a huge mess. And he told me last year he took all of his bank statements and credit card statements and fed them into Chat GPT, and it spit out his financials for him. Within a couple of hours, he answered a few questions, it asked clarifying questions, and it gave him his financials. He took them to a CPA and they filed his tax return with that. I haven't tested that. I don't know if anybody here has. I thought that was very
It'll do it. If that's the only instruction he gave it, I'd hate to think what the results were. That's the worst kind of sledgehammer accounting you can do, right? But I'll tell you, like if you did this test and like if he did that last year, I would be shuddering at the results. If he did that this year, I would actually say, yeah, it's probably got a good chance of getting it fairly close. The improvements in the models since December of last year have been huge. Improvements.
I'm not sure I would have filed them if I was a CPA.
No, I
It
would be
wasn't
the same, but maybe he didn't tell the CPA that's where he got his numbers from. He just said, here's a trial balance. I've had people try to do that to me too. I'm like, no, we don't do that.
Yeah, that's not happening.
You want my name on your tax return? I want the return to be correct. Okay. Any other questions? Great conversation. Hey, Jay. Didn't see you there earlier. Okay, well, thank you all. If you have any questions, don't hesitate to email. Make sure, I mean, most of you, if you signed up for the webinar, you will get my my weekly newsletters. So don't hesitate to reply to any of those if you have questions. And I look forward to chatting with you all in the future. And some of you I'll see in May in Salt Lake City.
Okay. Thanks, Peter. This was great.
Okay.
Thank you, Peter.
Thanks, everyone.
Thanks, Peter.